Trading the news is one of the most dynamic and potentially profitable strategies in the financial markets. However, it's not without its pitfalls. Understanding how economic events impact market movements and earning from both successes and failures can give you a significant edge. I'm a professional trader, and today we're diving deep into the world of news trading, including common mistakes to avoid. So, let's get started. Why economic news matters in trading. Economic events are like the heartbeat of the financial markets. They can cause sudden and significant price movements across various asset classes, including currencies, stock, commodities, and bonds. News such as interest rate decisions, employment reports, and GDP data often act as major market drivers. But why does this happen? Markets are driven by supply and demand, influenced by investor perceptions and expectation about the future. Economic news provides fresh data that can confirm or contradict these expectations, leading to adjustments in positions and, consequently, price movements. For instance, if traders expect the economy to grow and a GDP report confirms this, stock prices may rise. Conversely, if the report shows a slowdown, markets might react negatively. Being quick to interpret and react to these events can give you a significant edge. However, it's crucial to understand both the potential rewards and the inherent risks, such as increased volatility and the possibility of slippage. Key economic events to watch. Not all economic news impact the market equally. Let's delve deeper into some key events that tend to have the most significant effects. Interest rate decisions. Central banks, like the Federal Reserve in the US or the European Central Bank, meet periodically to set benchmark interest rates. These decisions influence borrowing costs, consumer spending, and business investment. An unexpected rate hike can strengthen a currency but might negatively impact stock markets due to higher borrowing costs. Non-farm payrolls (NFP) released on the first Friday of every month by the US Bureau of Labor Statistics. The NFP report measures employment changes in the US, excluding the farming sector. It's a key indicator of economic health. A higher than expected figure suggests economic expansion, which can boost the US dollar and stock markets. Gross domestic product (GDP) reports. A GDP represents the total value of all goods and services produced over a specific time period and is a comprehensive measure of a country's economic activity. Quarterly GDP reports can set the tone for economic outlooks. Surprises in GDP data often lead to significant market reactions. Inflation data (CPI and PPI). The Consumer Price Index and Producer Price Index measure inflation at the consumer and wholesale levels, respectively. Central banks closely monitor those figures to make decisions about monetary policy. Higher inflation may prompt rate hikes to cool off the economy, affecting various markets. Central bank minutes and speeches. Beyond rate decisions, minutes from central bank meetings and speeches from the key policymakers can provide insights into future monetary policy moves. Geopolitical events. Elections, trade negotiations, and geopolitical tensions can also have profound impacts on the markets. For example, Brexit negotiations significantly affected the British pound and European markets. How to trade the news effectively? Trading the news isn't just about reacting to headlines, it's about preparation and strategy. Here's how to position yourself effectively. Pre-event preparation. Economic calendar. Regularly consult an economic calendar to stay informed about upcoming events. Prioritize events based on their expected impact. Understand expectations. Know the market consensus and analyze forecast. This helps in gauging how much of the news is already priced in. Technical analysis. Identify key support and resistance levels on the charts that might come into play during volatile movements. Set up alerts and notifications platforms alerts. Use your trading platform's alert features to notify you ahead of key events. News feeds. Subscribe to real-time news feeds and financial news outlets for instant updates. Develop a trading plan. Scenario planning. Outline possible scenarios. This means if data is above, below, or meets expectations, and plan your responses. Entry and exit points. Determine your entry points, profit targets, and stop loss levels in advance. Risk management. Decide how much capital you are willing to risk on each trade. Trade with caution. Volatility management. Be prepared for increased volatility, which can lead to wider spreads and slippage. Avoid over-leveraging. Use leverage cautiously, as it can amplify both gains and losses. Stay disciplined, stick to your trading plan, and avoid making impulsive decisions based on emotions. Let's walk through a real-world example to illustrate how news trading works, including potential pitfalls. Suppose the Federal Reserve is scheduled to announce its latest interest rate decision. Leading up to the event, market analysts widely expect a rate hike due to strong economic indicators. As a trader, you observe that the US dollar has been strengthening in anticipation. Scenario 1, rate hike as expected. Market reaction. The rate hike occurs as predicted. Potential mistake. Assuming the USD will continue to strengthen without considering that the news may already be priced in. Lesson learned. Sometimes when an event meets expectations, the market reaction can be muted or even opposite due to profit taking. Action. Monitor the market's immediate reaction. If you notice hesitation or a reversal, it might be an opportunity to short the USD for a quick retracement. Scenario 2, rate held unchanged. Market reaction. The Fed keeps rates unchanged, contrary to expectations. Potential mistake. Entering a trade without a plan, leading to panic and poor decision making. Lesson learned. Surprises can cause extreme volatility. Without a clear strategy, you might enter at the worst possible time. Action. Stick to your pre-planned scenarios. If the USD plummets, look for confirmation before entering trades and use stop-loss orders to manage risk. If you're finding this content valuable and want to delve deeper into effective news trading strategies, be sure to join our Telegram channel. We share exclusive insights, real-time trend signals, and tips that can enhance your trading performance. Our community of traders is active and supportive, helping each other navigate the complexities of the market. Click the link in the description to join now. Trading the news can be highly profitable, but it's also fraught with risk that can lead to significant losses if not managed properly. Here are some common pitfalls and how to avoid them. Overtrading due to excitement. The issue. The thrill of volatility can tempt traders to place multiple trades without proper analysis. Real-life example. A trader might jump into several positions during an NFP release, only to find that rapid market swings wipe out their account. Solution. Limit the number of trades and focus on high probability setups. Quality over quantity is key. Ignoring risk management. The issue. Neglecting stop losses or using excessive leverage can amplify losses. Real-life example. A trader over-leveraged on a position expecting a favorable GDP report. The report disappoints, leading to a margin call. Solution. Always set stop-loss orders and use leverage cautiously. Never risk more than a small percentage of your capital on a single trade. Chasing the market. The issue. Entering trades after the initial move has happened, often leading to poor entry points. A real-life example. Seeing a currency spike after a news release. A trader entirely late, only for the price to reverse. Solution. Avoid impulsive decisions. If you meet the initial move, it's often better to wait for a retracement or the next opportunity. Not accounting for slippage and spreads. The issue. High volatility can cause slippage and widened spreads, leading to unexpected losses. Real-life example. A trader sets a high stop loss, but due to slippage, the order is filled much lower, resulting in a larger loss than anticipated. The order is filled much lower, resulting in a larger loss than anticipated. Solution. During high-impact news releases, adjust your stop losses to account for potential slippage and be aware of widening spreads. Emotional trading and revenge trading. The issue. Allowing emotions to drive decisions, especially after a loss. Real-life example. After a losing trade, a trader tries to immediately recover losses by doubling the next position size, leading to further losses. Solution. Take a step back after a loss. Stick to your trading plan and maintain discipline. Tips to avoid these mistakes. Educate yourself. Continuously learn about market behavior during news events. Understanding patterns can help you make better decisions. Practice with demo accounts before risking real money. Practice new trading strategies in a simulated environment. Keep a trading journal. Document your trades, including the rationale, outcome, and emotion involved. Reviewing these can help identify patterns in your behavior. Set realistic expectations. Not every news event will present a clear trading opportunity. It's okay to stay out if the setup isn't right. Risk management in news trading. While news trading offers opportunities, it's essential to manage risk effectively. Use appropriate stop-loss orders. Volatility stops. Place stop-loss orders at levels that account for increased volatility to avoid being stopped out prematurely. Guaranteed stops. Some brokers offer guaranteed stop-loss orders, which can protect you from slippage but may come with additional cost. Position sizing. Risk per trade. Limit your risk to a small percentage of your trading capital, commonly 1–2% per trade. Avoid overexposure. Be cautious about holding multiple positions that could be affected by the same news event. Avoid emotional trading. Stay calm. Rapid market movements can be stressful. Keep emotions in check to make rational decisions. Avoid revenge trading. If a trade goes against you, don't try to immediately recover losses with impulsive trades. Technical tools. Use indicators. Tools like the average true range can help you understand current volatility levels. Monitor liquidity. Be aware that liquidity can dry up during major news releases, affecting trade execution. Tools and resources for news traders. Enhance your news trading strategy with the right tools. Economic calendars. Websites like Forex Factory, Investing.com, and Trading Economics offer detailed calendars with filters for impact level and currency. Real-time news feeds. Services like Bloomberg Terminal or Reuters Icon provide instant news updates, though they can be pricey. Trading platforms with news integration. Platforms like MetaTrader and Thinkorswim often integrate news feeds and alerts. Analytical software. Tools like AutoChartist or Trading Central can help identify technical setups, pre- and post-news events. Common pitfalls and how to avoid them. Be mindful of these common mistakes. Ignoring the spread. Spreads can widen significantly during news events. Always account for this in your strategy. Overtrading. The excitement of news trading can lead to taking too many trades. Stick to high probability setups. Lack of preparation. Going into a news event without a plan is a recipe for a disaster. Trading the news can be both exhilarating and challenging. By understanding the impact of key economic events, learning from negative experience, and being aware of common mistakes, you can improve your trading strategy and reduce risks.